guys, welcome back to another week of Mortgage Matters in Minutes. Again, I'm your host, Brent Rasmussen, owner of Mortgage Specialists. A question today that we get quite often is, how much house can I afford? And people are looking for a very simple answer, and there's lots of information out there on TikTok and other social media sources that try to calculate and explain very easily or complicated how much of a house you can afford. And the simplest answer is everyone's finances are completely different. Some people like to save a lot. Some people like to take a lot of vacations. Some people like to, spend their money and enjoy life. And every situation is different. So we're going to go through a little bit of the scenarios here to help you calculate how much of a house you can afford at a simple basis, not at a very complicated basis, because there can be a little bit more factors than what we're chatting about today to get you the answers that you need. So first, what you need to do is assess your financial situation. Are you ready to buy a home? We've had many videos about this. But what do you like to spend your money on? Is it all for fun? Are you anticipating saving money for retirement, for insurances such as life insurance, disability insurance? Anyways, all the different things that can happen to you, from long-term care to retirement planning, college planning. Do you have an emergency fund set up? And then also review your incomes and your debts, because we're going to do a quick math here at the end of this to be able for you to calculate out how much of a home price, or really a home payment, that you can afford to keep you in your budget and hopefully your lifestyle in a normal, accessible, successful lifestyle. Second, you want to determine how much you would have for a down payment. That would make a little bit of difference and making sure you have a down payment. But for simple math, we're going to back into things. Also, one thing you would want to look up is what you feel property taxes and homeowners insurance are in that area. Because we're going to do a quick math formula. It's not complicated. It's simple division and addition to give you a calculation of how much house can you afford. Because consumers really want to know, can I afford a $200,000 house, $300,000 house, $500,000 house? As mortgage professionals, we're concerned more about a formula called debt to income ratio. And what debt to income ratio is a simple division problem that you would have learned in third, fourth grade or second grade, that we're going to divide your monthly debts by your monthly gross income. And that's really all it comes out to be. It's very much that simple. But we have to plug in what our income and what our debts are accurately to get a correct answer. And we just chatted about every part of the country, especially even every part of the Omaha metro area. Taxes and insurance can be different on each price range of home. So when we do our calculations for lending, we are looking at the debt to income ratio. We're not looking at the specific home necessarily or a specific home price. What we're going to tell you is, here is the max payment, or here is a payment that you can afford. I would always suggest to you to not go with the maximum amount that you can afford. That's not going to work out generally for you long-term in the budget, and for you to keep your house and making sure you're having your vacations and life bills paid for. So if you've been sticking around long enough, let's start doing some math calculations, some very simple math calculations. Most consumers know how much they make per hour per year. The easiest way is to get your income to an annual basis. Okay, let's say that happens to be $60,000, and that's before we pull out federal income taxes, state income taxes, things like that. We'll use the gross income. So if we take $60,000, we always want to get your income down to a monthly basis. So let's divide $60,000 by 12. And that comes out to be $5,000 a month. Okay, so now we have the $5,000 a month. A very accurate rule of thumb is about 25%, or actually the rules say 28% of your monthly income can go towards a housing expense, rent, mortgage, you name it. Obviously, people spend way less than 25%, and people spend more than 25%. It depends on your situation. So in this example of 60,000, we get your monthly income down to a basis of $5,000 a month. So then we're looking at your monthly, if we divide that by 25%, we're looking at $1,250 is going to be your payment that you can afford. Well, now the issue comes out to be, okay, I know I can afford $1,250, $1,250 in a principal, interest, taxes, and insurance payment. What does that give me for a home? And us as mortgage professionals always have to go about and estimate what property taxes and homeowners insurance are to then narrow that down to where does that put you in a price range. That is the exact math all mortgage professionals are going to do. We can't say just because you make $60,000, you're going to afford between $200,000 and $400,000. We don't know that. We only know that by the debt to income ratio that's out there. So besides doing that debt to income ratio, there's another one called the total debt to income ratio, which means all of your bills divided by your income can generally be at about 40%. Can you go higher than that? Sure. Some loans will let us go up to 50%. So let's do the same type of math. $60,000 a year salary divided by 12. You're looking at a monthly income of $5,000. $5,000, let's call it 50% for ease of use. That leaves us with $2,500. So now, in order to qualify for a home, we have to back in all of our debts into $2,500. Your new mortgage payment, any car payments you have, any child support alimony you have, credit card monthly payments, car loan monthly payments, student loan monthly payments. Any of those payments all have to fit within that $2,500 in order to qualify for a loan. So if we add that $1,250 in housing expense, that leaves us with $1,250 in other debts that we can have. You might be a little confused, so let me back up just a little bit and state every person's debt situation is different. So if you have very low debt, you can afford much more of a home price or a more housing payment. If you have high debt payments per month, you can afford lower of a house payment. Again, the math is very simple if we break it out, but we want to make sure and put in there correct information. Most consumers don't know what property taxes looks like in the area. They don't know what homeowners insurance costs are. And if you estimate too low and you do the math and you say, well, according to this, I can afford this payment, which should be about this home price, that can get you into a world of hurt if you're not putting the correct numbers in. So generally, if you want to do some very, very quick basic math, 25% of your monthly income can count towards your housing expense. But you also have to calculate your total debt to income ratio, which is all of your debt payments have to be within 40 to 50% of your monthly income. So the easiest way to remind you is to break down all of your income and monthly expenses or monthly debts into a monthly amount, the payments, not annual. And that will allow you to calculate the formulas properly. A lot of people don't want to go through all of this. So the easiest way is to contact a mortgage professional like ourselves here at Mortgage Specialists, and we can have you do a simple application. And we're going to do the same math for you. We're going to obtain a credit report. We're going to see what your monthly debts are on your credit report. And we're going to see how much income you have to leave that room for how much of a home price payment of a home that can be qualified. And we'll calculate that into a home price. And we'll say, hey, a $200,000 home payment is this. A $300,000 home payment is this. And we'll be able to tell you, here's a range that you can factor in. So again, that range can change. There's no black and white answer of saying you for sure can qualify for a $300,000 house, because we don't know if that $300,000 house has taxes of $2,000 or $5,000. And that makes a difference into these math calculations when you are getting pre-approved on how much you can get approved to. So I know sometimes when we explain to clients your pre-approval amount is this, and they say, well, is that the black and white answer? Not necessarily. We can move that up and down depending on each different house you look at. Hopefully today this isn't as confusing. It isn't. We deal with this every single day, and we're very well versed on this. Our intent today is just trying to give you a basic, quick math understanding of how you can look at your own finances to determine maybe what you can afford. Because I know a lot of people go out to Zillow or websites, and the math is what the math is. Bad math in gives you bad math out. It always has and it always will. So we, as the local mortgage professionals, want to give you the accurate numbers. So that way you're not looking at a $400,000 home and be told later when your loan finally gets to the underwriters that you can only afford a $300,000 house. Again, I'm Brent Rasmussen, owner of Mortgage Specialists. You can reach out to us anytime at 402-991-5153. or you can check us out on our website at mtg-specialist.com. Thank you again, as always, for checking in, being educated, and being the best buyer and or seller that you can be. Have a great rest of your day. Mortgage Specialists. Driven, trusted, reliable.